Sustainability and sustainability reporting are still in their infancy and suffering from growing pains, such as a lack of definitional clarity, uncertainty about how to measure non-financial information, and confusion over new standards by new standard setters with varying ideas about what is important to disclose. In this segment, we look at the latest in the sustainability field and explain why it is becoming a critically important new growth opportunity. We begin our report with Richard Kravitz, Editor-in-Chief of the CPA Journal. It should be noted that all opinions expressed are those of Mr. Kravitz and do not reflect those of the CPA Journal, the New York Society of CPAs, its management, or its staff.
Rick, welcome to the program.
Thank you very much, Becky.
Rick, let's start with the basics. What is sustainability reporting?
That's a very good question, Becky. 84% of the value of a corporation lies hidden in its intangibles. These are the non-financial assets that make a company really, really great. Its reputation, its brand, its logo, its reputational capital, its goodwill, its an intelligent workforce, and others. Sustainability reporting attempts to show how management manages these intangibles and how they report and disclose non-financial information, which is critically important to investors, and also talks about the long-term viability of the company.
Rick, so tell me, what is it not?
Becky, what it's not corporate social responsibility. It's not the companies giving back to the community in profits and in donations. That's great, it's admirable, but that does not ensure the long-term sustainability of the company. And it's also not a science. It's not empirical. It's not an experiment. It's like GAAP. It's judgmental. And in fact, two different people could have different opinions of what is considered a material, non-financial asset. In addition, the driving force behind this, surprisingly, is the investment community. They're concerned about the quality of a company outside of its financial information. They're concerned about the long-term viability and sustainability of the company.
Why is sustainability reporting of critical importance today?
I think what's really amazing is that 52 out of the 100 largest global economies are not countries, but they're multinational corporations. In addition, out of the thousands of publicly traded companies, the top 2,000 publicly traded companies employ 87 million people. That's more than most countries. And in fact, they produce over half of the gross domestic product of the world. So this is significant. And in fact, even if you look at Walmart, Walmart has 2.2 million employees. That's more than half the size of the population of New Zealand. This is incredibly important.
So let's take a look at sustainability in a little bit more detail. How would you define sustainability?
Well, in my editorials, I've looked at 4 different definitions. One definition is if we infer that a more socially responsible company that practices an ethic of sustainability will generate greater permanence, greater long-term profits, and greater viability than others that don't do that, that's one measure of sustainability. Michael Creighton, Professor Creighton, would define sustainability as the nexus of financial, social, and environmental factors. The integration of these 3 will also improve the long-term sustainability, viability, or permanence of the company. Then I give you a third definition. The third definition is what I call the unbalanced sheet approach. What counts is often not measured, and what is measured often doesn't count. For example, if we talk about the types of intangibles, like goodwill, like brand equity, like an intelligent workforce, these are the types of intangibles that make a company great, but they're not measured in traditional financial statements. And finally, I looked towards Tom Friedman in his book, Hot, Flat, and Crowded 2.0. And Tom says that a company that practices an ethic of sustainability is a company that's too good to fail and too strong to fail, but not too big to fail.
Rick Kravitz referred to Professor Michael Creighton of Providence College. Becky also sat down with Professor Creighton to get his perspective on sustainability reporting and how it differed from integrated reporting.
Michael, let me start by welcoming you to the program.
Thank you. Delighted to be here.
So, Michael, how is sustainability different from integrated reporting?
Well, Becky, they are related to each other. They overlap, but the motivations that gave rise to integrated reporting as a discipline are different than the motivations that gave rise to sustainability. Integrated reporting came out of financial reporting. The motivation behind integrated reporting was that companies should not simply report on financial assets, financial liabilities, financial revenues and expenses, but they should also report on the value of all assets and liabilities, of all resources that they use to produce their products and services. And as a result, if a company utilizes other resources, resources such as the natural environment to produce its products and services, it should report on that as well. As a supplement to financial reporting, these non-financial reporting items give rise to the phrase or the discipline of integrated reporting. Sustainability is different. Sustainability comes out of an altruistic desire to have our corporations and other organizations do well by society and do good things for society. It comes out of the world of corporate social responsibility. And as a result, when, to use my example of a corporation that is utilizing natural resources, when a corporation does that, in addition to the integrated reporting folks wanting to measure and quantify the use of those non-financial resources, the sustainability folks, the corporate social responsibility folks, look at the use of natural resources and say, if those resources are depleted or polluted, there will be bad outcomes for society, and we should be concerned about that. So between integrated reporting, which is purely a quantitative or business discipline, and sustainability, which is a more socially oriented, altruistic discipline, both disciplines look at the same types of transactions or activities and express concern about them, but they are approaching them from very different motivations.
Michael, I know that the Rhode Island Society of CPAs formed a task force that aims to produce an innovative accounting model that reconceptualizes traditional financial statements. Can you tell us about that?
Sure. We came together and created the task force a couple of years ago to see whether or not our new economy organizations required an entirely new way of doing accounting or should continue to follow traditional methods of accounting. And what we concluded, the central finding of our task force, was that the traditional models of accounting fundamentally still worked. They were still quite valuable, but they needed to evolve. They needed to be transformed in order to appropriately account for the value created by our new economy organizations. So for instance, in the old economy, older traditional organizations have assets and then they have liabilities. But their assets and their liabilities are two different sets of items. They're not necessarily related to each other. In the new economy, however, you have certain types of factors or variables of success. And the same factor can either be an asset or a liability based on how well or how poorly that factor is managed by a company.
Can you give us an example?
Let's consider, as an example, the workforce of an organization, the human resources or the human capital of an entity. If the workforce of an entity is well-trained and well-motivated, it might serve as an asset, a beneficial feature of a company. On the other hand, if the workforce is poorly motivated and poorly trained, then it might actually serve as a detriment or a liability to that same company. And therefore you have a feature or a facet of the firm, its workforce, its human capital, that might, at any given moment in time, swing in value between asset and liability, between benefit and detriment. To refer to such a resource as either an asset or a liability is simply, on the one hand, to continue to use the terminology of traditional accounting, but to conceptualize and to measure an asset/liability on this scale or continuum of positive to negative value is actually something that is radical. It's different. It's an evolution of traditional accounting standards. And that was one of the key findings of the task force that we were able to produce.
Measurement is a critical part of sustainability. Becky explored this further with Rick Kravitz.
Rick, how is sustainability assessment performed? Can you give us some examples of measurement techniques?
I think we have to look outside of the States for this. In fact, we have to look to the United Kingdom for guidance. Last year, the Financial Reporting Council created a program to improve the reporting and the knowledge and information on non-financial information. 153 global FTSE 250 companies participated in this study. And the results came through a report which is obtainable online from the Financial Reporting Council called the Extended Auditors Reports. What are some of the things that they looked at? And you see 153 companies reporting on some of these areas. Going concern risk, geopolitical risk, environmental risk, enterprise risk, also sector analysis. They looked at the economic sectors, the health of the sectors. They looked at employment. They looked at credit card debt. They looked at the workforce, the ability of the force to get to their destinations. And in fact, 93% of the global 250 companies do some measurement in sustainability reporting. The issue, however, it's not comparable. It's not comparable to other industries, companies in its sector. And there's no uniform standards. There's no uniform guidance. And there's no enforcement. And frankly, there's no assurance or guarantees.
I've heard references to the 3 Ps. What are the 3 Ps of a sustainable business?
The 3 Ps are generally known as plants, profits, and people. Plants, which is the sourcing of the supply chain. People, the quality of the people and human capital. And P, the quality of profits. It's asserted that if we integrate all 3, that this will give you a much better sense of the tangible value of a corporation.
And I've also heard reference to the 6 capitals. What are the 6 capitals?
This is actually fascinating. It was a concept created by the International Integrated Reporting Council, which is a consortia of organizations. It's located in the United Kingdom and Wales. It was founded in 2010. It was revitalized in 2011. But the 6 capitals, the idea behind the 6 capitals is that these are capitals that a company benefits from, but they don't own. And let me give you an example. The first, of course, we know is financial capital. But the truth of the matter is, the way this is approached is that the management of the company doesn't own the shareholders. They don't own the debt holders. And frankly, the profits come from customers, which they also don't own. So that's financial capital. Manufactured capital, which is the second, are goods and services that are manufactured. But if we look at it, this is roads, this is infrastructure, this is waste plants, this is all the manufactured goods and the supply sources for the company. And frankly, from a road or infrastructure perspective, if you can't get your employees to the company, they can't generate the profits. The third capital is intellectual capital. It's trademarks, it's copyrights, it's trade dress, trade secrets, it's expert knowledge, it's software development, and others. Again, this is not one of the capitals that's generally measured in financial statements. The next one is human capital. The motivation, the skills, the techniques, the technology that the people have. It's the DNA embedded within the corporate structure. Again, not measured in most financial statements. And social capital, which is the fifth, is a very interesting one. It's a relationship between the company and its community. And there's no better example of how there was a breakdown. There's no better example of the breakdown between company and society in the destruction of Detroit by General Motors, for which Detroit has still not recovered. And finally, natural capital, the number 6, is both the environmental and the non-environmental issues regarding a corporation's behavior. And I think and it also includes biodiversity. And I think there's no better example of the lack of biodiversity when you think of the potato famine in Ireland and the resulting famine in Europe as a result. The lack of strains of biodiversity, in particular plants and animals.
What is the role that global organizations play in sustainability reporting?
Well, to date there's 3. It's the International Integrated Reporting Council, there's SASB, and then there's the GRI. SASB is a relatively newer elephant in the room. It's located now in California. It's underwritten in part by Michael Bloomberg. And SASB is trying to pattern themselves after the FASB and the GASB and some of the other standard-setting boards. They've actually created 80 standards in 10 to 12 industry sectors. Again, they're paralleling what we in the States understand as standards boards, standard setting. The Global Reporting Initiative is actually the earliest, and it initially started through a United Nations program. It was actually the United Nations Environmental Program. In 2002, they recently relocated to Amsterdam, and they established themselves as a not-for-profit entity and opened their doors as the official center of the United Nations Environmental Program.
How prevalent is sustainability reporting in the U.S.?
Approximately 58% of the companies in the United States report on something relating to sustainability. Today, we look at it as CSR, or corporate social responsibility. But again, what they report on is inconsistent. There's no uniform standards. There's no uniform rules. There's no uniform comparability among the largest corporations or comparability within the sectors within that industry. There is no assurance, there is no enforcement, and in fact, it's a very loose, unorganized reporting among the 58% of the companies currently reporting.
Becky spoke with Professor Creighton again to get an illustration of how sustainability applies to U.S. businesses.
Can you use Apple as a useful illustrative example of the concepts that we've been discussing?
Sure. Apple has a workforce worldwide which is relatively unique amongst technology companies, or any company for that matter. When people think of Apple's workforce, they think about the individuals who work for the company in its headquarters location in California. And indeed, these people appear to be very well trained, very well motivated, and very productive. And yet, if we sit back and reflect with a little more consideration as to what the Apple ecosystem, Apple defined broadly, is like, we might conclude that the factory workers who work for Apple's suppliers in China are also Apple's employees, perhaps not in a legal sense. They're not legally employed by Apple, but they are individuals who labor, they provide value that is ultimately enjoyed by Apple, and they are compensated for their time. In addition, there are people who work in Apple's string of retail stores around the United States. These individuals are indeed employees of Apple Incorporated. However, we don't often think of them as being employed by the parent technology company because they work for the retail store chain. And as a result, if we needed to understand the true value or the intrinsic value that Apple's workforce provides to the organization, not defining their workforce in a strictly legal sense, but defining their workforce in terms of all the people around the world who work and provide value to the organization. We would have to look at their traditional workforce in California, the extended laborers manufacturing their products for other firms in China, and the individuals who work serving customers in their retail stores around the country. Now, the knowledge that they all bring to the table, the ability that they demonstrate to do their jobs well, their ability as a collective group to provide products and services that not only represent what people want to buy, but that give people who are customers of Apple a warm, fuzzy feeling that they are buying something of immense value. All of that contributes to the value of Apple's brand. That brand value, that reputational value, is immense. And it comes from, it is generated by, and it is supported by the efforts of all of these people around the world, whether they are legally employed by Apple or not. On the one hand, their ability to do their jobs well as individuals and in an integrated sense has driven the brand value of Apple to an immense positive amount of value. That is their brand value, and it is an asset. However, if something were to go terribly wrong in a factory in China or in a retail store somewhere around the country, that positive asset could flip and become a liability for the company very quickly.
Becky spoke with Rick Kravitz for some examples of organizations doing sustainability reporting.
Can you cite an example of a U.S. company that is doing a good job related to sustainability?
Becky, that's a good question. United Technologies was the first company in 2013, the first Dow Jones Industrial Average company to provide an integrated sustainability report. They presented 7 KPIs, 7 key performance indicators, and I'd like to read some of them. Greenhouse gas emissions, industrial process waste, worldwide water consumption, lost work days, recordable accident rates, energy efficiency, health and safety, and environmental performance. These are all measures of sustainability. But as you can see, there's no standards, there's no uniform measures, there's no enforcement measures, and there's no comparable standards around the world for this. But they were the first.
How about in the European Union? How prevalent is sustainability reporting there?
We have to look to the UK first for this, because globally, 93% of the global FTSE 250 companies are doing some reporting. 58% of the largest global companies, according to PricewaterhouseCoopers, have a special section on corporate social responsibility. But again, it's not integrated within the financial statements. Another stat that's being thrown out is that 51% of the 4,100 reporting companies included sustainability in their financial reports.
So why the differences between what's happening in the U.S. and the European Union?
I think there's two differences. When you speak to partners of the largest firms in America, it comes out that they cite legal issues or perhaps conflict with the securities laws and others. Let me give you an example. In GAAP, we're talking about whether materiality is a Supreme Court decision or a financial accounting standard or a government accounting standard or a PCAOB standard. The word materiality is totally different for each. The same is true in sustainability reporting. And I think the fear of the accounting firms providing assurance is that they may consider something a material, the accounting firms may consider that the sustainability issues that are material for one company may not be considered material by someone else or a third party. So that's the legal issues, and then they'll be sued from it. But I think there's also a cultural issue. When I lived in the Netherlands, there was a close social contract between the company and the community. And you could not move an employee, for example, more than 25 miles away from the company they worked. That concept does not exist in the States. So I believe there's some cultural issues also that have to be overcome.
Rick, you know that our audience consists of financial professionals. What's the role of the CPA and the accountant in sustainability?
Becky, accountants are the heroes of this story. Or as Jane Gleason White in her book, Six Capitals, Can Accountants Save the Planet? Remarks, we do the job of measuring. We do the job of measuring impacts, results, financial outcomes in all areas which are part of the sustainability matrix, irrespective of what definition we operate on. And more importantly, my message is that we as accountants and financial managers and CPAs are charged with the responsibility of forging ahead to make sustainability and sustainability reporting and integrated reporting an essential intrinsic part of the business decision process. From the perspective of accountants on the outside, that's really good business. In fact, we can do this better than anyone else. So let's welcome the opportunity. Sustainability reporting may be the greatest Duke practice growth area for accountants and the highest area of interest for financial executives and financial managers and accountants. What is tremendously interesting is we held a new sustainability committee meeting at the New York Society of CPAs. And this was attended by over 150 members. Never before in its history had this level of interest been shown in any area in the accounting community.
So how are investors judging the value add of sustainability?
Well, this is tremendously interesting. And here's some of the responses from the investors based on a survey in this area from the Hedge Fund Roundtable. 62% of the respondents of the roundtable indicated that they believe that social responsible and sustainable investing are not mutually exclusive from generating attractive returns. But more importantly, 27% believe that disasters such as the BP spill have made it clear that ignoring these issues poses an even greater threat to returns than some of the financial issues of the companies. And finally, 71% of the Hedge Fund Roundtable's respondents surveyed indicate that there's been a tangible increase in investor interest in this area, and that the Hedge Fund Roundtable is well aware of the increasing importance investors are placing on environment, social, and government issues. I think the best place to look for guidance is through the Financial Reporting Council in their extended audit report in 2015. This gives you, in a sense, 153 companies that have taken a stab at improving their non-financial information and reporting it. You could look at industry sectors, you could look at the types of companies, and you could look at the type of information that they're reporting outside of typical financial information. I think it's a good place to get started.
Where are we going? What's the future of sustainability reporting?
Well, currently there are, as you know, 3 competing standard setters. And my editorial actually talked about whether we need an oversight board for these 3 standard setters. And there doesn't seem to be agreement like there isn't between the International Accounting Standards and the FASB. Are these principles-based, are these rules-based, or are they case-based? So we have the same issues in sustainability reporting that we do in regular financial reporting. But where we're going is there's more and more increased interest in this field, and I think we're going to see more and more reporting of non-financial information that's absolutely critical to the investors and to the long-term viability of the company.
To conclude the program, Becky asked both Rick Kravitz and Michael Creighton for a final thought.
Rick, if you could leave our viewers with one final thought on sustainability reporting, what would that be?
Guided by a global report by ACA, which surveyed over 5,000 students in 126 countries, the next generation of professionals, 87% say that finance and accounting professionals of the future will have to provide business with more decision-making insights than now. 79% say that sustainability issues will be more prominent in business than ever before. 74% say that the environmental impact on organizations will be bigger for finance and accounting professionals in the years ahead. And 54% say that in terms of integrating sustainability reporting into business are issues that the young professional really wants to become more and more involved in. And as I mentioned, I've done some presentations at colleges. There's nothing that resonates more importantly to the students than the issues of sustainability, and actually is incredibly attractive to the next generation of accountants. But the final message is that 34% of the students surveyed in the ACCA survey say that the world will be a better place for them to live in.
And Michael, a final thought from you.
I would say that sustainability as a discipline is closely integrated with the field of integrated reporting. And in order to understand what an integrated reporting model looks like, it is not at all necessary to reinvent the wheel. One does not have to create an entirely new and unprecedented model of accounting. Accounting, going back to the founder of double-entry bookkeeping, Luca Pacioli, who first codified accounting back in the 1490s. Going all the way back to that gentleman, the value of any entity is simply the aggregate value of all of its assets minus the aggregate value of all of its liabilities. The difference between valuing companies today and valuing companies in the past is that the assets and liabilities that companies use or own today are simply different than the assets and liabilities they've used or owned in the past. And as a result, although the fundamental model of accounting stays the same, the applications of the model are different. Now, when you apply the model, you will find that there is a business component and there is a social component. Corporate social responsibility is based on this altruistic desire to use accounting to force organizations to do things for the benefit of society. If one wishes to do that, however, in my opinion, it is critically important to have an objective and unbiased accounting system that can accurately measure and assess the benefits and the problems that companies are creating for society. Integrated reporting is the objective and unbiased measurement process by which we can hopefully achieve the altruistic mission and motivations of the discipline of sustainability.
Rick Kravitz, editor-in-chief of the CPA Journal, published by the New York State Society of CPAs. A lot of great information, and thanks for being here today.
Thank you so much, Becky, for having me.
And Professor Michael Creighton, thanks to you as well for being here today.
It is my pleasure. Thank you.